Hey, it's Matt Decker with Leveraged Wealth Management. I hope that you're doing well today. I've got a topic that has been something on my mind for a little while now, and it's using life insurance as its own asset class. And it is its own asset class, and there's a lot of reasons why. So I want to real quickly just lay out why I think life insurance, number one, is really its own asset class, and then number two, why you should consider adding it to the mix of what you've already got. Before we go into the why, we first have to understand, the typical asset classes as they exist today, and maybe some of the risks that are associated with those asset classes. So let's just start with what you're all used to. The primary asset classes as they exist right now, and I'm sure that there's nothing here that you haven't already heard of. So, we've got equities as a primary asset class. You've got fixed income. This can come in a variety of different ways, but equities, fixed income. You've got like a money market or, just cash. And then the other big one's going to be real estate. So these are, oversimplified in terms of what's out there as an asset class, but those are the four primary asset classes, that exist today in traditional financial planning. So let's also talk about the risks that are associated with some or all of these asset classes. So the first risk that we have to balance out when we're talking about, retirement planning and where your money is, number one, we've got market volatility. We've also got taxes, longevity risks. So that would be, living too long or outliving your money. And then the last one that we'll put on here, let's just put inflation. So here are your typical risks associated with, the primary asset classes that you're probably used to. So obviously market volatility goes with, equities. It's also going to go with fixed income in some form or fashion. If you're talking bonds there's still market volatility with bonds. And really to an extent, or, to a little extent, it's going to also be tied to real estate. The real estate market sometimes can go as the market goes. Taxes could apply to every single one of these, of course. Longevity risk could apply to, the equities, maybe not so much the real estate, maybe not so much fixed income either. And then inflation is definitely going to apply to fixed income and the money markets. So we've got some risks that are associated, and that's not a bad thing. Everything comes with a pro and a con, but there are some risks associated with, these primary asset classes. So why life insurance? Why does life insurance get its own asset class? Well, the reason that I think it needs its own asset class is because it's quite a bit different from just about every other vehicle that's out there that you may have already considered or are currently considering. So I'm going to go through just some of the highlights, maybe not highlights, but just some of the reasons why I think life insurance should have its own asset class. Number one, it has a low correlation to the actual stock market. We'll expand on that a little bit later, but that's probably the most important thing. So when we say low correlation, what that means is when the market's down, most life insurance policies, unless it's a variable policy, are not also down. So you can have a bucket of money in the market that's losing because the market's down, and your life insurance policy, if it's structured the right way and if you've chosen the right one, it's not going to behave in the same way. So it's low correlation to the stock market, which is actually a huge deal for your overall portfolio. Let's dive into some of the specific reasons why I think life insurance should really get its own asset class. So the first one's going to be protection. And what I mean by protection is protection for your beneficiaries. So why does this give protection for your beneficiaries? Well, it's a self-completing plan. If you put in $1,000 into a life insurance policy and you get hit by a bus, you're not getting $1,000 back. You're getting the death benefit back. So that $1,000 might have purchased a $400,000 death benefit, $1 million death benefit. It depends on what you're doing and how old you are, but this is a self-completing plan. If you put $1,000 into the stock market and you get hit by a bus, you're going to get $1,000 plus or minus whatever the market did that day. So it is not a self-completing plan. Putting money in the market, not a self-completing plan. Putting money into fixed income, not a self-completing plan. Putting money into real estate, not a self-completing plan. You're basically going to get out what you put in, plus or minus whatever growth you may have experienced along the way. There's no leveraging of your dollars to go to your beneficiaries. So that's the first one, protection. The next one's going to be tax diversification. So we'll just put taxes. And the reason that I say tax diversification is because if this is done correctly, your life insurance policy is going to grow tax-free. So you get tax-free growth, and you're going to get tax-free distributions. Again, if it's structured the right way. So not only do you get tax-free growth on your money, you're not paying taxes from year to year, but when you actually go to take the money out of the plan, you're also not paying taxes. So that's pretty unique. There's only a few vehicles that offer that as a feature. Add to the fact that your self-completing plan, the death benefit, is also tax-free. So tax-free growth, tax-free distributions, tax-free death benefit. From a tax standpoint, life insurance really checks all the boxes. The next one is going to be market diversification. And we already touched on this a little bit, but to expand a little bit further, these policies, most of them, if done the right way and if you're choosing the right one, are going to come with a 0% floor, meaning the worst that you can do in any given year is going to be 0%. So if the market's down 10 or 20, your life insurance policy is going to get 0. And at the same time, for that 0% floor, you're trading off on some of the upside. So there might be something like a 15% cap on the upside. So you're never going to get more than 15, but you're never going to get less than 0. And that's really interesting when you combine that with some of the more traditional asset classes, because what it can do is it can really diversify the market risk out of your portfolio. It's really important that when the market's down, all of your money is not in the market, because that means all your money is down. And if you're retired, you still have bills to pay. The market doesn't care if you're retired. I'm not sure if you knew that, but yeah, the market doesn't care if you're retired. The market also doesn't care if you have bills to pay. The market's going to do what the market's going to do regardless of your situation. So you better be sure that you have a chunk of money, a slice of the pie that's not subject to market risk. Because when the market's down, the worst thing that you can do is dip into that account and start withdrawing money to use it as income, because now you're really compounding the problem. We'll get into the compounding effect of losing money in a little bit, but I want to finish this list. The last reason that I think life insurance should really be its own asset class is because you have more access and flexibility. And the reason that we're putting this on the list is because when we look at other vehicles that have some of the similar features from a protection standpoint or a tax standpoint, oftentimes you're giving up access and flexibility. So just a quick example, the Roth IRA is another vehicle that's going to grow tax-free and come out tax-free. The downside, though, is you don't have access to the gains inside your Roth IRA until 59 and a half. So if you're young, you're giving up some access to the money. Another one would be, if you're trying to avoid market losses and you're using an annuity. Annuities aren't bad, but they're certainly not flexible. And so this vehicle gives you a tax benefit from tax-free growth, tax-free distributions. It's a self-completing plan, meaning there's leveraged dollars if you pass away, and it's diversified away from market risk. And for those three benefits, it's the most flexible vehicle that you can choose from, and it's the only vehicle that's going to do those things that doesn't limit the access to your money based on some IRS guidelines like a 59 and a half rule. So we'll just say more access to your dollars when you want. So those are the main 4 reasons why I think life insurance really should be treated as its own asset class. But let's end with something that I mentioned a little bit earlier, and that is withdrawing money from an account that's down is really compounding the problem. I want to expand on that because it's probably the most important concept that we could go over in this video. And the reason I think it's the most important concept that we could go over in this video is because for whatever reason, this is often overlooked by traditional financial planners. And so the idea is, when you lose money, how long does it take to get back to even? So let's just do a little chart here. We've got a nice little chart, and we'll say on the left-hand side, we'll say that this is the loss percentage. So how much did we lose? And then over here we'll say, well, how much do we need? What percent do we need to break even? What percent do we need to break even? So let's say that you lose 10% of your money in the market. How much do you need to now break even? Well, you might think you lose 10, you gain 10, you're back to even, but that's not actually how it works. If you lose 10%, you actually need 11% to get back to even. Now, if at the same time you dip into this account and withdraw money in order to live, because again, the market doesn't care if you have bills to pay, the market doesn't care if you're retired. If you withdraw money from an account that's down, all of a sudden, it's a lot more than 11% that you've got to make to get back to even. Let's go a little bit further. Let's say that you lose 20% in the market. How much does it take to get back to even? Well, if you don't take any money out at all, if you have another pot of money that you can withdraw from in retirement and you can leave this alone, you're going to have to gain back 25% to get back to even. What about 30%? What if you lose 30% in the market? Well, now it takes 43% to get back to even. And this scale just keeps getting worse and worse and worse, to the point where if you lose half your money, you now have to gain 100% in order to get back to even. Most people don't think of investing that way. This is why Warren Buffett's first rule of money is don't lose it. His second rule is refer to rule number 1, don't lose it. Because when you lose money, it takes a whole heck of a lot bigger returns to just get back to even. And if you're also using that money to live and you're spending it, then the math gets really, really difficult to overcome losses. And that's why it's exceptionally important that you have a pot of money that is not correlated to the market. Now, my opinion, why life insurance as an asset class? Because it solves that problem extremely well. Not only is it not going to be correlated to market risks and to the fluctuations and the whims of the market, but it's also going to keep up with inflation. It's also going to give you a tax benefit, and it's also a self-completing plan. It checks all those boxes. So if we go back to that first list of risks associated with your typical asset, or your typical asset class, we had, as a refresher, we had market volatility, we had taxes, we had longevity, and we had inflation. A properly structured life insurance policy is going to be able to keep up with inflation. A properly structured life insurance policy is going to come with some phenomenal tax benefits in the form of tax-free growth and tax-free income, tax-free death benefit. The death benefit is going to take care of our longevity risk, and the right life insurance policy is not going to have any market volatility. It makes it a perfect slice of the pie. Should you have all your money in life insurance? No, probably not. Should you have a chunk of your money in an asset class that's not subject to market risks, that's going to give you some tax benefits on the way out, that covers you in the case of living too long or not living long enough, and is going to keep up with inflation? Absolutely. You should have a good chunk of your money in an asset class just like that. Now, I think that life insurance is one of the best ways to solve those 4 risks that are associated with your traditional asset classes that you all are familiar with. If you'd like to see how I typically use life insurance as an asset class in the form of retirement planning, you can actually go to my website and check it out. I've recorded a whole video kind of presentation that goes through exactly how and why we use life insurance as an asset class. You can go to leveragedwm.com/no tax. leveragedwm.com/no tax. It goes through a 45-minute video with some case studies that show you exactly how and why we use life insurance as an asset class in our retirement planning. Thanks so much. I look forward to talking with you soon. If you haven't already done so, subscribe to my channel, like this video, share it with your friends, and comment below on what you want to see next. Take care.